Welcome back. You're still watching Midcap Radar on CNBC-TV18. Let's do one thing. Let's talk about some of the big stocks in focus. Another interesting conversation on the big news of the day. JPMorgan has decided to include Indian bonds in its emerging market index from the 28th of June next year. Investors are cheering this move, which is expected to give a big boost to inflows into India. In fact, the stock of the day has to be PNB Gilts. It's hit a fresh 52-week high today. Its shares are locked in a 20% upper circuit. Remember, PNB Gilts is a primary dealer and its profits hinge on the gains or losses in the bond market. So let's invite Vikas Goel, the MD and CEO of the company, to discuss the opportunities that open up. Vikas, thanks a lot for joining in. India's inclusion in the global indices. Yes, thank you for being with us.
Very much on the show, and yeah, it's good news for us, indeed.
Absolutely, it is good news for you, and that's exactly why we've invited you here. I just wanted to understand first from your end, what is the exact opportunity for you? What kind of impact would this have on your business?
Well, as a new set of investors come in, obviously markets rally like any other normal market. And as we are a primary dealer in government securities, rallying market obviously is supportive for our business. Essentially, we have a balance sheet of about 22,000 crores of government securities. And as prices go up, it benefits us as a primary dealer. Quite apart from the fact that we are a market maker in these securities, so you have a new set of passive investors to finally, offload these securities to. So we have an exit to a new set of investors who are view agnostic, and they are essentially non-discretionary linked to the index which they are tracking. And this is, good passive flow, long-term flow, which is, good news for traders like us.
Mr. Goel, just to zoom out a little bit for the benefit of our viewers, if you could just explain PNB Gilts' business model. We understand that you are linked to, the bond prices go up, it's positive, you benefit from M to M. You explained that, but just explain the business model. How exactly, what's the role the company plays and how do you benefit?
So essentially, just to give you a feel for the industry and what we are, there are 21 primary dealers which are licensed by Reserve Bank of India. The license mandates the primary dealers, including PNB Gilts, to be a market maker in government securities, to support the government's borrowing program by underwriting the program, and essentially help in providing liquidity and price discovery in government securities market. That's a primary business. So essentially, it is a trading business. It's a view-based business. As you are aware, interest rates move up and down based on various factors, including monetary policy. So,
sure. Mr. Goel?
The net result of the intent of monetary policy and other factors are expressed in markets via intermediaries like us, like PNB Gilts and other publics.
So now with interest rates peaking, perhaps near peaking, right, and this bond index inclusion, can you quantify for us what kind of gains would you see on your holdings in FY24 and 25? Or rather just in FY24 by the end of the fiscal?
Okay, as you are aware, obviously it's difficult. Financial markets are uncertain. Having said that, this provides us a runway. So let me just say that this inclusion, this news here, this event is, it's not takeoff. It is, we are at the start of the runway, yet to start taxiing. So obviously we will taxi and hopefully we will take off in the middle of next year based on exclusively this event of index inclusion. Quite apart from this, it looks like inflation has peaked. H2 borrowing program is relatively easy. So these are additional factors from a macro standpoint and supply standpoint, which are supportive of good days ahead for us, particularly going into next year.
So you said you're one amongst the 21 primary dealers for Reserve Bank of India. What would your market share be? And suppose if we do see inflows of, it's estimated at say $40 billion, approximately what are the kind of commissions or spreads does the industry make?
So essentially, look, it's not we are not a fee or a commission. So we, like I said, we are market makers, which means that we create liquidity both on the buy side as well as the sell side. So we take the advantage to us comes from the fact that we take a view on markets, and we hold positions in terms of being long on securities. Essentially, we are long only market participants, while primary dealers also express views when rates are rising from the short side, much more so than other participants. But essentially, we are a long only participant. So given that there are new set of investors who are coming in, who are long only, when the prices go up, it benefits us. But the model and the primary dealer business is all about trying to take advantage of where the market will be in future. So essentially, we position ourselves based on our views of what the market will be doing in future. So it's not a commission or fee-based model. It's just taking a view on market and positioning and using our capital to take advantage of whatever opportunities the market offers.
Do you have any plans to enter into the equity business or perhaps a fee-based business?
Okay, so essentially, we as a primary dealer, our core business is making markets and underwriting the government securities market. But in non-core market, we are allowed to be in equity. So we do a little bit in equity. But primary business is fixed income. We are fixed income. We are bond people. We are fixed income people. So rate trading is our primary, business and core business. So and that will not change.
Mr. Goel, as you explained, you're largely long only. You take a view on the bond portfolio, and that's on the long side at PNB Gilts. What happens when bond prices fall down? Then it hurts your business. What are you doing to...
Yeah, so there are two things which can happen. So obviously, worldwide, not only for us, for market participants like us, when rates rise, worldwide, our bottom line suffers. But there are ways to mitigate and manage risk. One is by reducing duration. Second is by using derivatives like interest rate swaps to hedge the portfolio. Third is to go short on securities. Having said that, net-net, we will be long and we can mitigate the impact of rising rates, but we cannot entirely do away with the risk which we have on our books. So essentially, we cannot hedge the entire book. Having said that, we can mitigate it. So there are bad years and there are good years. So essentially, last year for all primary dealers was not as good as the previous 2 or 3 years. So we are exposed to interest rate cycles. That is part of the business model. You have very good years, you have average years, and you have low average years. Yeah.
So you've also got the RBI's not to act as an authorized dealer in the forex market. Any plans to get into that, and what could the opportunity be there?
Yeah, that's already in public domain. We have got the license and we are working on it. Hopefully before the year is out, we will be also in FX business, again making markets and taking views in FX markets. And this particular opportunity will additionally, because these foreign investors will also require some amount of hedging, so we can become a one-stop shop for them. Not only will they invest, but since they are dollar-based and they're investing in INR, they have dollar-rupee risk. We can offer hedging solutions to them, which our current license now allows us to do.
Mr. Goel, we leave the conversation here for now. Thank you very much for joining in. Look forward to chatting with you as and when you have clarity on the kind of benefits the company could see on your book. Get into a break. On the other side, we'll put the spotlight on Electronics Mart India in our segment Midcap Spotlight. Stay tuned.